Hello, and welcome to the CFI course, An Introduction to Risk Management. My name is Ryan Spendelow, VP of Content here at the Corporate Finance Institute. This introductory course is essential for anybody wishing to explore a career in the risk management industry. Today's financial services organizations face a complex web of interconnected risks, all of which need to be managed and mitigated in order to protect the company, the shareholders, the customers, and the ongoing stability of the global financial system. Therefore, risk management today is more critical than ever before in order to safeguard the bank's assets, its customers, and its shareholders. Without effective risk management, banks are at risk of failing. And due to their size and interconnectedness, when a large bank fails, it can lead to devastating consequences experienced at the global level. In this course, we will give you real-life and recent examples of what happens when banks get their risk management wrong. The course will also review the evolution of risk management to give you an essential perspective on today's risk management landscape. We will identify and discuss all the risks that banks and financial service organizations are exposed to. For all the risks that we will introduce in this course, I will give you the background you need to understand why managing that risk is important and how that particular risk might manifest itself should a bank or another financial service organization get the management of that risk wrong. Finally, we will explore the importance of managing risk at the enterprise level and describe the steps of an effective enterprise risk management framework. So, what is risk? Risk is the chance that something bad happens, or what we might describe as a negative event occurring. This event often ends up resulting in a financial loss or another negative outcome such as a damaged reputation. Risk management is the process of controlling these risky events in order to minimize these negative outcomes. There are lots of different risks that a bank is exposed to, and in Chapter 2, we will provide a fuller definition of risk and describe the spectrum of risks that a bank or financial institution is exposed to. But I wanted to start by looking at a couple of real-life examples of where a bank has failed or has been taken over due to not managing risk effectively. Let's start by going back in time to 2008. In January of that year, Lehman Brothers was one of the largest investment banks in the US. The previous year, in 2007, the bank had just booked a record profit of over $4 billion. The bank was deeply invested in mortgage-backed securities, or MBSs. An MBS collects lots of mortgages and pools them together into something called a special purpose vehicle, or SPV. Investors can then invest in the MBSs and receive payments from the underlying mortgages. The issue in 2008 was that many of the mortgages in the MBSs were made to borrowers with low credit scores, making them much more likely to default and making many MBSs incredibly risky. These mortgages were called subprime mortgages. Lehman Brothers created so many MBSs that they couldn't sell them all and owned billions of dollars worth, which they recorded as assets on their balance sheet. A US housing crash, which started in 2006 but was largely ignored by banks such as Lehman Brothers initially, ultimately led to the value of these MBSs crashing. Banks wanted to avoid doing business with Lehman Brothers as its exposure to these subprime mortgages was well known. As Lehman Brothers had to be able to do business with other banks in order to survive on a day-to-day basis, Lehman Brothers was forced to file for bankruptcy on September the 15th, 2008, with $619 billion in debts. Lehman Brothers had taken on too much risk through its MBS exposures. This excessive risk was enabled by the management team of Lehman Brothers, who encouraged an inappropriate risk-taking culture within the bank. In fact, the chief risk officer for Lehman Brothers between 2000 and 2007 has since been quoted as saying that risk management at the bank was repeatedly overruled. If you can remember that far back, Lehman Brothers wasn't the only banking crisis that year. Its small investment banking rival Bear Stearns in the US and Northern Rock, a savings and mortgage bank in the UK, were also victims of poor risk management. These banking failures were significant contributors to the global financial crisis of 2008, an event that is often referred to as the Great Recession. Credit Suisse was the second largest Swiss bank until its larger rival UBS took it over in March 2023. Swiss authorities strongly pushed the deal, believing it was necessary to avert another global crisis like 2008. Credit Suisse had a long history in risk management failures, leaving it in a dangerous financial position and its reputation in tatters. Previous failures in risk management led to multiple fines for tax evasion, which is a failure in compliance risk management, money laundering, another compliance risk failure, spying scandals, which harmed the bank's reputation and is an example of reputational risk, and forgery of documents. Fraud risk is often classified as a type of compliance risk. The bank took further losses totaling $5.5 billion after Akagi's Capital, a wealthy family office, collapsed. This was a result of more failures in compliance risk management, along with a breakdown in credit risk management. Similar credit and compliance risk management failures were at the heart of a $1.7 billion loss on a $10 billion exposure to Greensill Capital, a supply chain finance firm. And at around the same time that Silicon Valley Bank collapsed in March 2023, Credit Suisse admitted that failures in its risk assessment process failed to identify errors in its financial statements. These failures saw Credit Suisse's share price fall from over 12 Swiss francs at the start of 2021 to 1.86 Swiss francs when UBS took it over. Risk management within the financial services industry has evolved as organizations have become more sophisticated and in response to banking failures and crises. Banks began managing risk in a way that we would recognize today in the 1940s after World War II and in the early 1950s. Banks often took out insurance against risks to cover financial losses should risk materialize in their organizations. However, paying these insurance premiums became very costly, so banks began to explore putting rudimentary risk management policies in place during the 1950s. By the 1970s, complexity within the banking system had increased due to the more international nature of the business models being used by banks and through the introduction of derivative contracts. Banks invested more time and resources into identifying and managing risks as this complexity rose. The use of derivative contracts jumped in the 1980s as banks helped facilitate the increased use of derivative products by companies looking to hedge their risks. The very first dedicated risk management department ironically appeared in 1987 at Merrill Lynch, which was taken over in late 2008 due to the global financial crisis. Regulators at this time began to recognize the increased risk financial institutions pose to global financial stability. This led to the start of global banking regulations. The Basel Accord of 1988, known as Basel I, imposed a new regulatory framework to help banks manage risk. At this time, risk management was really focused on market risk, the risk of financial loss due to changes in the financial markets, and credit risk, the risk of loss due to customers defaulting on their loans. By the time the 1990s rolled around, risk management was a firm-wide issue, with risk appetite decisions made at the board level. Chief risk officers began to appear within banks. These CROs would later become board-level roles, reflecting the importance of risk management. global regulators enhanced Basel I by introducing Basel II in 2004. This was in response to a series of high-profile failures such as Barings Bank in 1995 and Long-Term Capital Management in 1998. In response to the global financial crisis of 2008, regulators again stepped in by introducing Basel III. Banks now had stricter definitions of the different types of risks that could lead to losses in banks and more guidance as to what strong risk management frameworks should look like. We're going to explore all the different types of risks that banks and financial institutions are exposed to, but I want to just dig a little bit deeper into our definition of risk. Risk is more than just the chance that a bank might lose money, although often that is the end result. Risk is uncertainty on future expected outcomes. In other words, if something is certain to happen, there is no risk. If a bank knows that it's going to lose $100 on a specific transaction, there is no risk associated with that transaction, even though the outcome is clearly negative. Let's look at an example. Banks lend money to customers in the shape of loans. The bank doesn't know with 100% certainty that they will be repaid in full. There is no guarantee that the borrower, despite their income, despite their job security, will be able to pay all the interest and the principal back when the loan is due, when the bank first makes that loan. In other words, the bank is exposed to risk. In this example, it's credit risk. Some future event, the possible default on a loan of a customer, could lead to a financial loss to the bank. However, it's critical to appreciate that if the bank hadn't extended the loan to the borrower in the first place, they wouldn't have generated any income in the shape of interest from that borrower. In other words, banks are in the business of taking risk. Banks have to take risk in all its various forms in order to generate a return. Banks that don't take any risk will have a very short existence. Now, if risk actually materializes for the bank, the result is often a financial loss. The financial loss might be losing money when a borrower defaults, as the earlier example shows. It might be a fine the bank has to pay if they've broken laws or regulations that led to the risky event happening. Or it might be a restriction in being able to do business or offer clients a particular product, which ultimately restricts their ability to earn future revenues. A failure in managing risk can also lead to reputational damage, which can ultimately lead to a financial loss. For example, banks have seen damage to their reputation when employees are found to be guilty of unlawful or unethical behavior, such as rogue trading in the investment banking division or selling inappropriate insurance products through its retail bank. So, how can a damaged reputation cause harm? Well, it can do so in a number of ways. Customers leave the bank and use a competitor. Future clients avoid doing business with the bank. The bank faces tougher scrutiny from regulators. Or shareholders decide not to invest in the bank. Now, let's move on and start exploring specific risks that banks are exposed to.